The world's biggest economies are colliding this week. Between shifting interest rates, US GDP, and China's factory output, the data is about to rewrite your portfolio. Here's what you need to know. Welcome to ACY Securities. I'm Ira Reyes, Macroeconomic Strategies. Today, we will take a look on central banks' interest rates, GDPs from Eurozone and US, China manufacturing, and the Japanese industrial production. Just a reminder, this represents my personal view of market movements and does not constitute investment advice. Trading involves a high degree of risk. Please ensure you have a solid risk management strategy in place. My strategic analysis is I utilize a dual layered approach that synthesizes macro level catalysts with technical precision. By cross referencing fundamental shifts against statistical trends, I execute high conviction trades where market sentiment meets optimized expectancy. Okay, so let's begin for the US. So let's have a recap of what happened. So yesterday, the US markets closed with a heavy sense of caution as a highly fractured Federal Reserve and a massive wave of big tech earnings kept investors on edge. So looking at the S&P 500, it closed to 7,135.95. That is a change of negative 2.85. And that is on the narrative side is flat as tech gains were offset by broader market jitters. And for the Nasdaq, it managed a tiny gain, if you can see it's in a green, due to cloud or AI optimism. Now for the Dow Jones, the clear laggard hit by sensitivity to bond yields. So looking as well on the VIX on the Chicago board. So why the VIX is up? It is due to heightened market anxiety surrounding the today's Federal Reserve announcement on interest rate. So a high stakes on big tech earnings this week and the persistent inflationary pressure from surging energy prices. So in short, we're still on being squeezed on the energy prices from time to time, not only in the United States but on the global indices as well. So who are the gainers from this? Alphabet and Amazon. So Alphabet stock took off after Google Cloud's performance confirmed that AI bets are starting to yield real profits. So Amazon followed, climbing on the back of strong cloud expansion. So for the decliners, we have the Meta and Microsoft. So Meta's price dropped as investors grew wary of heavy spending against low moving returns. Meanwhile, the Microsoft it showed a slight dip. Even though they beat expectations, the market was still holding out for even more aggressive future guidance. We also have from the euro. So here, looking at the euro markets, they are all also down or declining. So for let's begin for the FTSE 100. It hit by falling mining and healthcare stocks. For the German index, the DAX, Deutsche Act 10-year 40, it dragged lower by energy costs again and tariff threats. And for the CAC 40, it's relevant to the luxury and retail sectors taking a hit. So these are the main drivers for the euro markets. Now, let's talk about the UK US interest rate impacting the across the markets. So, as anticipated and expected, so the Fed the rates are steady at 3.75%. So, meaning the United States, the dollar will strengthen by the support of this interest rate. So looking on the edge, like for the gold, will this be suffice the gold? The US dollar right now is increasing, meaning the value increase. That means it's expensive. That's why we look on the gold side, wherein we see a bearish trend at the moment. So this match the forecast, the 3.75% and the previous rate, indicating a pause in the current cycle. So is this positive or negative? So positive to combat inflation in the US, because this was fueled by war, with rising oil prices, and with this is also negative for a relief in terms of, for example, in the financial side, borrowing costs. So there is a spark in the stock market valuations. Some view or expect this 3.75%, the cut here on the interest rate won't happen until September to December this year. Now, here the impact of the S&P 500. So historical report shows that from mid 2025, you can see here the historical, we see a clear easing cycle. So rates have dropped from 4.5% in June down to 3.75%, which is we are currently experiencing. So these flat bars that we are showing right now, it suggests that the Fed has reached a neutral level where they are comfortable holding rates to observe economic data. But the question is, how long would they be able to see this flatten along with the inflation rate that is currently increasing, being fueled by energy prices? So this is the question right now. Now, what is the market impact or the movement on the S&P 500 index? So looking on the candlestick chart here, so the S&P volatility in the 1 hour after the release. So despite the rate remaining unchanged, the chart shows a sharp initial dip followed by a recovery. So here we saw that from green, it became red candle. So this often happens as the markets or the traders, they digest the FOMC during the speech or Chair Powell's subsequent press conference remarks. That's how, if you look not only in the 1 hour chart, but also on the 30 minutes chart or 5 minutes chart, you will see some trading gaps, other indices, but this one on the 1 hour chart, they are really digesting every second that being spoken about the interest rate decision. So as the green line, this one is the interest rate, step from 4.75 to 3.75%, the blue line, the S&P 500, generally trended upward. So this is the comparison or the relationship. Now, lower interest rates typically boost stock valuations because it's not expensive to borrow by lowering borrow costs and increasing the present value of future earnings. Now, since the actual rate is 3.75%, the market is operating in the actual forecast territory. Historically, this leads to a decline of 56% of the time, likely because the good news that we are anticipating or we expect of a rate hold was already priced in, leading to selling the news reaction. That's why when we see this 3.75% beforehand, it's just a confirmation. You have already entered your strategy. Next, let's have an update on the OPEC, since we are talking about energy prices from time to time. So OPEC on the daily, it's already on 109.44. Last time we were updated is on 90 level, but right now it's increasing to 109.44. So this is the daily OPEC basket price. So how this we could relate as well with in terms of the WTI. So let's go to the chart of the WTI. Here, the WTI breached already the 100 level. So WTI surged to 100, closing price at 107 per barrel this week. So that means U.S. naval blockade keeps the Strait of Hormuz closed, cutting off vital global energy flows. So while President Donald Trump maintains the blockade to force a new nuclear deal, Iran has threatened retaliation against what it calls economic coercion. So this geopolitical standoff is intensified by record U.S. exports and plunging domestic stockpiles. It signals a severe tightening global supply. That's why from time to time you will see for example, in Germany, in Japan, energy prices are really making the tightens the indices. So if that specific country is really an energy importer, expect them to slow down growth in terms of their economy. Excuse. So WTI again, it jumped the market and has moved from worrying about a supply crunch to pricing in a long-term disruption. So it's catching up to the Brent as well as the world looks to US to shale to fill the massive gap left by the Middle East. So the recent price jump here, it stems from several major events colliding. First, the extreme geopolitical tension has pushed the market behavior beyond normal supply and demand rules. Although the UAE, as we have mentioned yesterday, leaving the OPEC, it would usually lower prices. But this one is a reverse because the market is instead reacting to these three immediate shocks. The Hormuz, the record of exports in US, it's the shift is an alliance to general market uncertainty. So here, looking at the chart, you can see I am using Bollinger Bands for me to see its volatility this week. Here, it's already clutching the upper band in different time frames. So even if you go to 4-hour chart, 1 hour, even 30 minutes, it's almost clutching on the upper band chart. That's why we see this one on a bullish trend at the moment. So the resistance that I'm looking at on the price is 113. This one is the high since March 19. After that initial shock, excuse me, from Hormuz disruption. Now, for the first resistance, I'm looking at if it will breach the 110 level. So, yes, it reached the 100 at the moment due to stalled diplomacy UAE exit. As the PMI trends improving economy, the USD CNH often faces downward pressure as the yuan strengthens. So looking at its volatility range, so it releases that exceed forecasts typically result in the 1 hour average floating rate of 0.033%, providing there's a benchmark for expected volatility during similar high impact events. Um, Also from the China, we have the rating dog manufacturing PMI. So this is um, the private manufacturing sector for China. So the figure it jumped to 52.2. So this figure comfortably cleared both the 51 level or 51.0 from in March the 50.08. So it's increasing. It shows that there's a robust growth in the China fueled by a surge in new orders. So here, the private sector, it stands in contrast to softer performance reflected in official government data. So the actual PMI 52.2, the forecast was 51.0, the previous month was 50.8, and the growth driver for this index is that increased volume of new orders. The trend is that the private sector, despite more sluggish official manufacturing indicators, the outlook here is that the PMI figures favor a stronger yuan. So the US dollar index, it remains a critical variable. If the upcoming US inflation, in case that will be provided or it proves elevated the US data, the resulting dollar strength could effectively neutralize the upward momentum of the yuan from this positive manufacturing report. Next, we have the in Japan industrial production. So same scenario, just like in Germany, Japan is an export heavy country. Right now, we are looking at the trend of the forecast. So the forecast is 1.1 and it was released negative 0.5. So this suggests that Japan's factories haven't picked up its speed yet. So there is a slow growth. For some, the MIS it reinforces a cautious outlook on the yen strength. When the manufacturing sector is not providing the economic boost, that would typically support a stronger currency. So based on this, there is production report and its implications that negative zero point 0.5 it already deep into negative territory, so it indicates contraction in industrial productivity. The forecast, the 1.1 anticipated, and the previous was on this level of negative 2. So the contraction slowed compared to the prior period. The sector remains far from hitting growth targets. So here, looking at the bar charts again, so the prevalence of blue bar sitting below the zero axis here, if you can see it properly, it highlights a period of persistent struggle for Japanese manufacturing. And the gap between this one, the green and the blue bar, the short blue bar, actual bar, it underscores how far the most recent data fell short of analyst optimism. So for the currency, again, USD/JPY, here's the reaction. It went green. So for the first 1 hour chart, it captures the immediate tug of war between the buyers and the sellers following the weak production report, and it correlated the movements with in terms of the light chart here. It shows that sharp drops in production data, which is the green line, and often meet with dramatic swings in the exchange rate, which is the blue line. Now, under forecast here, when the actual data is lower than the forecast, that is, it was today, there is a 54.5 probability that USD JPY will decline in the first hour following the release. And the over forecast, conversely, when the data is better than expected, there is a high of 81.8 or 82 probability of the price rising for the USD JPY. We also have the Japanese consumer confidence that is going to be released today. So here, um, one of the high impact data. So looking here, if the index measures how it measures the Japanese families feel about the economy. So a score below this one, the 50, means people are worried and likely spending less. So the news last April 9th, it was a big miss, 33.3 and 38% expected. So the shift right now is after growing for over a year, the consumer mood has suddenly turned different because people are tightening their belts and how the market reacted. As soon as the bad news, USD JPY went up, and what it means for the yen. So when the Japanese economy looks weak, the yen loses value. What do we see this one on a bigger picture is that for the past year, the dollar has been getting stronger against the yen, and now it's sitting between 158 and 160 level that we are always looking at. So what's the probability for this one? Historically, when the data is better than expected, the exchange rate rises 75% of the time, and during the first hour, usually we see a 0.10% price jump immediately after a surprise in the numbers. So that is for the Japan. And to summarize this one, weak confidence, would it be a weak yen? Because Japanese households are feeling less certain about the future. The yen is facing more pressure while the dollar stays strong. That's why we look from time to time, the Fed already 3.75%, which means it will make the US dollar stronger. Now we have the euro data for the inflation rate today before the ECB. Okay, okay, we have the euro GDP first. So here, this tracks the area of GDP growth rate, how fast the economy is growing, and how it moves the Euro USD right now. So the result last time it was 1.3% in the latest report. So that means there's a beat in the forecast of 1.2%. So the result right now is 1.3, and the latest report right now since the early 2024, the euro area has been slow but steady growth. That means slow but secured, consistently doing better than other analysts predicted throughout the 2025. And how the market reacted here right after the news, the Euro USD. The euro dipped but then quickly recovered and ending near the 1.92 level here on the chart. And to see this one, even though the economy is growing, the GDP is up, the euro has been under some pressure lately, stabilizing around 1.17 against the dollar. So here, is there what we're talking right now is the risk is that even when the growth numbers are better than expected, the euro falls 50%, 57% of the time in the first R, and its volatility range, an upside surprise, usually causes a price move of about 0.08%. So to summarize this one, growth is solid, but the euro is tricky. While the euro area economy is resilient, a beat in the GDP does not always mean that the euro will go up immediately. So, as market or investors, we often use these news to adjust for other factors like interest rates or other global trends. Next, we have the UK interest rate. So here, in the United States, we have the BoE interest rate decision that would be today. So we are looking if it going to stable at the 3.75%. So the outlook, inflation has ticked back up to 3.3%, largely due to higher energy prices, and the BoE is expected to keep rates higher for longer. So the analysts they view this one as another to hold, just like in the United States, 3.75. But the short term move is that if the pound spike around 1.335 against the dollar, and the reason is that investors they would like to see if this hawkish tone, that means they are seriously looking to combat this inflation, and the fact that all committee members voted the same way. So in short, in US, UK, and Euro are having the same statistical probability when it comes to interest rate decisions. So over the last year, interest rates have slowly dropped from 4.5 to 3.75%, while the pound or the sterling has remained strong, staying between 1.30 and 1.38. So probability for this 56% when the bank or the BoE does exactly what the analysts view or predict. So usually the sterling rises in the first R, and the hold effect for this one, even if the rate does not change, the sterling moves about 0.21% in the first hour as markets read the fine print of the meeting notes. So to summarize again, steady rates means resilient sterling or pound. The BoE is currently in the contraction or wait and see mode, while the next decision is likely another hold. Any surprise change in how committee votes could cause a big jump or drop for the sterling. Next, we have the ECB that we are looking at, the EU interest rate for the European Central Bank. So here, they kept interest rates at 2.15%, and right now the rates have leveled up to after a falling of 2.4 in the mid 2025. So the next update later, the market or expects this to another hold of 2.15%. So 2.15% is a tolerable. And first of all, this country, or I mean, the countries in under the eurozone are developed economies. So 75% probability when the ECB does exactly what the market expects, which happened 16 times lately. The euro has a high chance of rising against the dollar in the first hour. And the move for this one, traders usually see a price shift of 0.20% immediately following the announcement. So here, this is how the Euro USD reacted every time there is an interest rate decision. So here we can see to predict like a to see this one in a bullish trend. Even when the ECB does not change rates, the euro tends to gain strength. With another hold expected, history suggests a positive move for the euro USD. Just like in the US, they have already priced in, they have already factored in the risk before it was announced, because that is there already expected the interest rate. Now we have the US PCE. as well. Core index. Where's the- We have the US GDP growth as well. So let's begin first with the US GDP growth because this one is we're looking forward. So here there is an impact on the S&P 500 index. So here the gross domestic product growth for the United States. So why the S&P 500? It's why is it so sensitive to the GDP? Um, the index is effectively serves as a mirror for the broader US economy. So when GDP growth accelerates, it expands the total pool of wealth available for corporations to capture. That means because this index tracks the 500 largest market leaders, their collective revenue is fundamentally tied to the pace of national economic activity, making the index highly responsive to any shifts in the growth rate. So the current situation right now is we are looking at 1.4 that was released February. So this was a massive compared to the 3.3% that they expect. So growth is slowing down significantly from the 4.4% that is high seen last year. So we are expecting a recovery at 2.1. That is the forecast that would be today. So markets use this to see if the economy is healthy enough to support stock prices. So by historical, if the GDP beats 2.1, that is over forecast, the index has a 100% historical chance of rising. Investors, they prefer that there's a proof of a comeback. And if GDP misses the 2.1, that means under forecast, there is an 80% probability the index will drop in the first hour. So this means that better growth means higher stocks. Today's data is a make or break moment. A strong number above 2.1 has a perfect track record of boosting the S&P 500, while another miss will likely send stocks lower. So let's look on the charts as well. Now, this is the Nasdaq 100. So you can see that the Nasdaq right now, just like the S&P, it's all going high despite of the um, fundamentals that being reported. Now I see this one 27 500 level. This is the ultimate that I see as a ceiling. This one is a bullish breakout. So 27 300 positive level if goes underneath, expect hesitation for this one. So I am pointing out this level 27 300 to 27 315 level. So this one acts as a psychological ceiling because it marks the highest price the market has recently reached. And whenever an index climbs to previous peak like this 27 300 for example, it hits a wall of selling coming from two distinct directions. So again, my ultimate ceiling is 27 500, and this one is my psychological price of for the Nasdaq is 27 300 to 27 315. Now what I'm talking about the two distinct directions. So for profit takers, these are the traders who bought during the recent slump of 26 level, this one, because it dropped here at 2600, 26,000 below. So for them, that 27 300 or 27 315 that I'm talking is a logical finish line where they sell to cash out their wins. Now for the trap bulls that the other one that I'm saying is that these investors bought at the very top right before the market fell, so in April. So after sitting on losses for weeks, they are relieved to see the price return to their entry point and sell immediately just to get out even. Um, you can for further discussions on this, you can check our Discord, the description below here in our box. You can see it and you can message us for that direct questions in terms of this kind of scenarios when in we see some trade gaps and we also see some short selling and high selling as well. Now, on top of this, one of the drivers for the Nasdaq 100 is that the Apple earnings that we are anticipating. So there is a dominance in the Apple because Apple holds a massive percentage of the index. So major institutions often move to a neutral stance. So they avoid aggressive buying until this market heavyweight clarifies the trend with its results. Essentially, the market is holding its breath because Apple is the captain of the Nasdaq team. No one wants to run too far ahead until they know the captain is healthy and the new leadership plan is solid. So here, again, 27,500, that is the bullish breakout if we see this one, and 27,300, this is the psychological level. For the first support I'm looking at is 26,792 because this has the number of times or frequency touch this level for this month, which means the volume plays here when it comes to trading. And here we have 26,683, that is the support price. If breach, it could potential decline. And I have the correction level wherein 26,400 level, wherein I'm looking at if this reach this level, they might push another level, and this is the we are looking at the critical level for the Nasdaq at this period, including the energy cost that is rising. So to evaluate this one, how do we see the Nasdaq? The Nasdaq is trapped in a valuation squeeze, meaning the combination of high borrowing costs. So high borrowing cost, that means we already factored in the federal interest rate, the 3.75. Soaring energy prices crushes both corporate profitability and investor appetite. So high interest rates are making tech stocks right now more expensive to own. High energy prices and war uncertainty are eating to corporate profits. So the index is hesitating at this level 27,300 because it's technically tired and fundamentally pressured by a world that is currently too into the inflation and too volatile, which means the geopolitics as well. So RSI right now, if you're going to look at, is around 65, and on some time frame it's around 70 to 71, but it's beginning to curl downward. This means the market is top heavy and requires a fundamental catalyst like a blowout from the Apple report just to justify this further extension. So when the RSI hits level 70 to 71, usually the Nasdaq is considered overextended. This doesn't mean a crash is coming, but it leads to consolidation. That means sideways movement as the index for the moving averages to catch up to the price. So the market right now is currently leaning slightly cautious. So most traders right now are sitting on their hands until that Apple reports is going to be released and we see where the bonds as well yield settle. So the upside, if the Nasdaq stays above 27,300, we could see a push back toward 27,500, which is the ultimate ceiling I'm saying, provided that the Apple matches the strong AI hype like what we saw from the Microsoft and Google. And downside is if the interest rates keep climbing and Apple's forecast disappoints, expect a quick drop toward 26 level or 26,579. So expect sharp fluctuations for this because of the Fed on what to do next. The Nasdaq is going to react sharply to every headline and data point that drops today. So moving forward, we have the Euro USD. So here, yesterday, Euro USD opened at 1.1718, high at 1.1718 as well, low at 1.1671, price close at 1.1686. So again, it's on the 1.16 level that we are always looking as a struggle on this pair. So the momentum for this one, the pair peaked at the open and stayed under pressure all day. After hitting a low of 1.1671, it staged a small recovery toward the closing bell. Volatility range for this one, the trading remained compressed with a 47 pip spread, it signals that there is a hesitation for a trader because of today's central bank decisions. So for the trend closing at 1.1686, so the pair confirmed its recent momentum loss, losing its grip on the 1.17 flat handle. So that means this first resistance, it's losing its grip right now. And if you are looking on the chart right now, I'm using again the Bollinger Bands, it's really clutching on the lower band. So we see bearish momentum for this one. Now, yesterday, it was a long-term bullish structural shift and immediate downside pressure from geopolitical and energy-driven catalysts. So after that rally lost its steam to this level, it's causing the bulls to retreat. So the 4-hour chart here, right now I'm using, is the outlook. It has turned slightly defensive on the market and it struggles to hold above these major levels. So for my first resistance would be 1.17 flat, and if the price below this, we could refer this bears or the sellers, they are in control. If it gets back above it, things look more positive for the euro. And the support is 1.1665 that I am showing right now. So this is I would say the support floor price. If the price hits below this one, it could drop much further though downward to 1.15 flat. That is the worst scenario that we're looking at. So here, my to conclude this one, this is a bearish neutral, and the euro needs to break these levels to prove it's actually getting stronger, and even before the ECB interest rate decision. So, what are the main drivers for the euro USD for today? We have the inflation rates, so 2.6. Usually, high inflation is bad, but right now it's forcing the ECB to keep interest rates steady rather than cutting them, which actually helps the euro stay afloat. And energy stress again, oil is expensive. It's around 107 to $108 per barrel. So because of troubles in the Middle East and the UAE leaving the OPEC, this gives stress in Europe more than the United States because Europe imports more energy, which puts the pressure on the euro. And in terms of economic growth, as one of the drivers, Europe's economy is growing slightly faster than the US right now. This growth is the main reason the euro has not crashed completely. That's why from time to time in a week you will see 1.70 to 16, which is right now because they are trying to squeeze their prices in terms of how would they be able to cope up with the energy accelerating prices. So today, two major banks are speaking, the ECB, that is how will they be hawkish or tough on inflation, and if it's good, if it's yes, then the euro goes up. For the Fed, we already knew it's 3.75. The dollar might get stronger and pushing the euro down, but again, we are on a different time zone. We are still on the hopes for the euro to go uptrend. And the war news, any positive news regarding the Strait of Hormuz conflict possible to hit the US dollar index to drop. And speaking of that, seeking safety, which could send the Euro USD higher. So for this one, for further in-depth analysis, you can join with our channel again in our Discord, and the link is in the description box below, and you can use this code for the trading sign up here for the ACY securities. Also, we have market analysis that we have provide on a daily. So here you go to acy.com and go to the news analysis, and you can hear a range of market analysis, education that you can look at for further backup when it comes to trading. So today, this is our outlook for today, and hope you got more information, in-depth analysis into this report. And today, have a great day. Have no fear. Ira is here. All is well. Thank you, and see you on our next live session.